Welcome to TheoTrade. This is Don Kaufman. It's June 6, 2018. You are watching the Theo Night video with 4 minutes left in the trading day. People, S&P futures are now up 18. And we'll look at that here in just a moment. But before I do that, I want to bring you into the SPX. Why ultimately the SPX? Because the SPX is right on the cusp of the expected move. Now, for those of you that do tune in from day to day, week to week, we talk extensively about expected moves here. This is how the option market, prior to the week even beginning, this is how the option market depicts risk. And this week we were looking for a $33 move higher or a $33 move lower. There's absolutely no directional bias to this expected move, and we're literally to the edge of the expected move. Now, does that necessarily mean that the market is going to crater from this point? Is the market going to sell off to this point? No, not necessarily. But it's incredibly important to look at this also on an intraday basis, how the expected move, which again we defined on Saturday, is being adhered to, and we're just, again, stone's throw off the edge of that expected move. And that's something you really want to take into consideration as this week progresses. Clearly, it's already Wednesday and Wednesday evening. The market's closing here. But come Thursday and Friday, there is a very high likelihood, that we trade back inside ultimately the expected move. Now, on a broader sense, let's go over to the S&Ps for just a moment. So you're thinking about the SPX and that we can trade back inside of the expected move of the SPX. But back over to the S&Ps for just a second. If you take a look at the S&Ps, and very often I'll show you a 30-day 1 hour. Well, this is a 30-day, again, 1 hour on the S&Ps, and we're in the highs of the last 30 days. So I decided to take a little bit of a look back. Instead of going 30 days, we're actually going to cruise out to 90 days, and we're actually going to bump this out to 2 hours, hit OK. And what I effectively want to show you is we're right back to where we were in the midst of some of the extreme volatility all the way back in kind of mid-March. We're right back up into that like 2760 handles inside of the S&P futures. Anyway, one of the things, again, that really stands out, it's not necessarily the move up in the S&Ps. In fact, again, if you remember back to the video that I did this past weekend, people have been asking me lately, hey, make some bold calls in the marketplace. And one of those calls happened to be, we were absolutely looking for markets to trade higher this week. We are looking for them to head higher to ultimately see a reversal thereafter. At this point in time, well, we've gotten some of the up move. Now, what is going to be the trigger to reverse this? Doesn't necessarily have to be one. One of those triggers could be none other than, well, the SPX has already exceeded its expected move. But here's one item that I want you to think about, because I've looked extensively at the financials lately, and the financials, which have been really lagging, exploded to the upside today. That has everything to do with the bond market, and this is what I wanted to show you. The bond market late in today's trading session has a very small bid under it. What that effectively means, and I'll zoom out here for just a second, what this means is if there's any degree of carry through to the upside in this bond market, it'll actually pressure the financials and it will reverse the S&Ps. That is, the S&Ps are going to turn around and sell back off. Now, we're going to completely switch gears on you for the next few minutes, because I want to think a little bit more. There's the closing bell. I want you guys to think a little bit more about the market as a whole, because there is some very interesting opportunities that have now presented themselves that we have not had in many, many months. Now, a lot of this has to do with volatility. If you've seen any of the news lately, the volatility itself has extraordinarily large short positions. That is, traders are out there and they're shorting volatility. They're selling options in volatility. They're getting outright short volatility. I mean, how do you go out and short volatility? Because there is no underlying VIX. You can't sell a VIX that isn't there. So what they typically would use is they would sell volatility futures. Okay, so there's this massive underlying short volatility position going on in the overall marketplace. And what's a little bit unique about this short volatility position is, again, this is the largest short volatility position that's been on record since, okay, mid-January. And that's, of course, right before volatility absolutely exploded. Now, do not get me wrong for a second here. Just because traders are short volatility, in no way, shape, or form does that dictate that the markets are going to tank, because it does not. Okay? In no way, shape, or form am I saying that the markets are absolutely going to tank. Okay? I am not dictating to you that the volatility is going to explode. However, with this size of a short volatility position in the marketplace, okay, it changes the notion, the very notion of risk reward inside of the S&P 500. Now, the last time that there was this large of a short volatility position, it cost the S&Ps $5 trillion in market cap. Again, this is not, me coming out, oh, I'm bearish. All I'm saying, okay, is that because of the extensive short volatility complex that is currently in place, it makes it very opportunistic to carry very, very inexpensive, far out of the money positions in the event that the marketplace tanks and tanks hard. All I want is what I would call an outside shot. This happens to be a relatively lower probability trade. All right, this is a trade that, hey, it might pay off, but when it pays off, it pays, all right, 10 to approximately 1. It pays you $10 for pretty much every dollar you have at risk. So I'm actually going to take you through and build one of these, and I've got a number of them already in place, but I couldn't think of a better time to want to build one of these spreads. Now, this is what we call the risk twist spread. And without going into too much detail, the trade is designed, again, for an outside shot. Let me first build it here. So we're going to go out and we're going to sell a 272. We're going to buy 1, 2, 3 of the 262s, and we're going to turn around and sell one of the 260s. Now, this trade is done out in September. It's done for right in the neighborhood. We'll call it about a $1.30 debit. I'm going to right click on it and I'm going to cruise over to analyze the trade. So we are now looking at the analysis of this particular position. What we're doing is we're going out and we're buying a trade all the way out in September. Why September? The longer duration on the options actually give us more sensitivity to changes in implied volatility. Now, this is a strategy that I've used a number of times. Great thing about it, it's only placed quarterly. I don't have to go out there and like, oh, I got to route it and got to route it and I got to route it. No, it's just placed quarterly. And again, this is not saying that the market's going to tank. It's an outside shot. Now, how far does the market have to sell off for you to have, okay, a degree of profitability? Well, first of all, the S&Ps right now, the spiders, are trading 277. And you can see that this thing, it really starts to catch fire down here in like the 250 range. But that is not, okay, that's not including the fact that if the market sold off, volatility would effectively go where? We go up. So again, this has a lot to do with this short volatility complex. Let's just move the volatility up by 5 points. If the volatility moves up 5 points, look, this trade really starts to grip hold in the 260 range, right? And that's just with a 5-point bump in volatility. Now, if the VIX was to get over the 20 region, let's just add 10 volatility points to this, okay? This thing absolutely explodes. This is 1 unit of the risk twist spread, literally 1 unit of the risk twist spread. If the market were to sell off, okay, in the neighborhood of, for instance, what, 250, one contract is making in excess of about $1,200 to $1,500. Don't get me wrong, this trade does and can have risk. You have to refer back, for all of you that are TheoTrade members, you have got to refer back to the entry and exit criteria of this trade. Okay. Yes, this is a constructed trade. Yes, you can go out and route this particular trade. In fact, you can see I'm carrying positions in it, but you have to be able to not just put a position on. Putting a position on isn't necessarily going to make you money. This thing has to be monitored. If in the event the market sells off big, we have to exit this position and exit it profitably. And the trade absolutely has risk if you're not aware of how to close it properly. This marketplace, again, in this big, heavy, short volatility kind of complex, and there's articles coming out, everybody's talking about it again. Why? Because it's amazing. It's amazing that just a few months back, okay, the world almost blows up because everybody's short volatility. Here we are again a few months later in the exact same position. So why not take an outside shot? Why not take a trade that if the market does completely crater, we're going to be in the right place at the right time? Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.